The ceasefire is yet again collapsing. Today we're going to be discussing the effects of the collapse of the ceasefire on markets, especially risk assets. So that information that we got recently in the past few hours is pretty important because it sets the tone for the next remaining days of the ceasefire, right? So from the start, the markets reacted very positively. We rallied all over. Oil came back to its lower levels, not still elevated, but much lower than before. But on the first day, we saw Iran break the ceasefire. We saw Israel do the heaviest bombing on Lebanon, and they also broke the ceasefire. So this is not really anything new, nothing unexpected, but it definitely makes things worse for the future. So we're going to discuss the impact of that, and then we're going to discuss the 3 scenarios that could play out from here on. All right? And each scenario will have a different bear to bull ratio that we should know as speculators in the market. So before we start, I'm Mo. I'm a crypto and macro market speculator, and I've been a speculator for the past 7 years. So I hope you enjoyed this video and you learned something from it. Well, the importance of ceasefire for markets is quite large because it has an indirect impact on economies, global economies around the world. So everybody knows now, by now, that Iran controls the Strait of Hormuz, which is used to transport 20% of the oil and gas to the world, right? Especially the most affected countries are Japan, South Korea, India, China, and then you go to the EU and so on. Now, also, Japan being heavily reliant on the oil from the Middle East and not being able to get it, almost 90%, is quite worrying. We will discuss it at the end of the video, but I'll give you a little bit of a hint. Do you remember the Japan carry trade? And do you remember that Japan has a lot of US treasuries that they could sell anytime? Which, in line with the private credit crisis in America and already the quantitative tightening that's going on and Feds, then you also get that last domino. All of them just... Recessions do not happen because of one thing, but it's a lot of things at a time. And then usually there's the catalyst, the one thing that breaks everything. You know, the one card, it's like a house of cards when you take one card and it falls around. But it's not only because of that card, right? It's because of the whole structure, because of a lot of factors going on. Well, I wonder what's that last factor is. We will see, but definitely something to talk about as well. So usually you get around 60 vessels, all right, and ships transporting stuff, especially oil, through the Strait of Hormuz. In the last 24 hours, despite of the ceasefire and the agreements that they will reopen the Strait of Hormuz and stuff like that, we're only getting around 7 a day on average. So that's 6% of the capacity of the strait. And we shouldn't take that lightly, right? Let me explain something simple. So if we go to the chart of oil, this is where it all comes back to, right? All this conflicts just goes back to oil. So it is quite logical to study the effects of elevated oil prices on markets, right? So think of it this way. Geopolitics, what's going on right now, predicts, and by studying the geopolitics, we're able to speculate and predict oil prices, okay? And if we, in turn, speculate on oil prices, then we're able to predict and speculate on markets, right? So as a speculator in the market, whether you're if you're technical or macro driven, people are, I believe people are a mix of both to different extents. On this channel, we discuss both the macro and the technical view, right? So we try to merge them to get a full picture. So the macro view is the oil supply and the closure of the Strait of Hormuz. The technical view is where are we now currently compared to history, and what does that mean on the economy, and what will happen to the economy mean to the markets. The absolute oil price right now is not really the problem. Now, it is a problem, but the absolute price is not really the major problem. Of course, lower absolute prices is good. It is the relative price, the change, the rate of change that it happened. So we previously were at like 56 a barrel, and we were in that regime for quite a long time, since April 2025. And previously we were in a different, slightly elevated regime in 2023 to 2025. But going below that and under that slowly over years is fine. But being elevated from bottom to high around 112% and at current levels 73% in such a short time, let's measure the time. It has been 115 days, but we've reached those levels in just around 83 days from bottom to peak, right? That's quite a shock. Now, you get these recessions and problems in shocks usually, right? This is why we study this shock. Now, if you, after doing some research, right, and studying market cycles previously, you start to understand that 70 to 85 a barrel can be absorbed by economies. All right, if we get elevated to those levels, it's natural, is good. That's why here we were doing just not too bad. But when you go up to the level we are currently, even in the upper bound of that level, between 85 to $100 a barrel, that's when pressure starts to build on economies globally. Now, that pressure can be sometimes handled and maintained if economies are doing well, or the Fed wasn't already dealing with inflation previously, then it would be more okay. But right now we're struggling. That's one. Two, if we get to the macro stress zone, that's very, very dangerous for economies. That's why every time we get there, Trump and global leaders try to calm everything down and put the price down. That's why every time we wick there, we just come back straight down. But the price keeps retesting. So I'm not sure, but it seems like a trend going up. That's one. And sometimes charts tell you about things before they happen. Macro things, right? Right now, it seems like we're retesting the low ranges of that bound, and we might go higher. Now, I do hope we just make a kind of a horizontal range and just wick above it sometimes. That would mean we will just get shocks and we just persist in the pressure building zone. But if we trend higher, that means something, again, is going to happen soon. And one thing of that today is ceasefire collapsing. So we've already started to see the effect of elevated oil prices in inflation data. If you've been living under a rock, I hope not. If you're a speculator, you always have to be vigilant, right? The headline inflation, which was very expected to, wait, where is it? Is that, yep, that's the headline inflation, which was very expected to rise, did. And the reasoning is simple, because headline inflation uses oil in its calculation directly. That's why it's seen there very quickly. But we have jumped from 2.5, right, 2.4 or something, to 3.3. I mean, that's not small. That's quite large. That's a 40% move, right? And you get usually recessions and stuff like that in periods where you get shocks like that, right? Breakdowns, breakups. So it's not the best thing that we want to see. Here's like, this is the most relevant. The OPEC, right? Headline inflation was going up, and that's when we have seen a recession. That was in 1973. All right, let's mark that, 1973. The next data point to be hit is usually the core inflation. And why is it important to track the core inflation more than the headline inflation? Well, the reasoning is simple. Feds and central banks around the world do not care so much about headline inflation because it's volatile. It spikes and goes down, and it spikes with oil and housing and all that stuff, right? It's not really important. It's important, but not so important. Core inflation is quite important because it does not include oil into its calculation. So core inflation is the thing that is felt by people around the world. And then businesses feel it a little bit later as well. So if core inflation stays elevated and continues to go up, that means central banks around the world will be more hawkish, especially the Fed in America. If they are more hawkish, then that means they are less likely to drop interest rates and increase liquidity and perform some form of quantitative easing. If they worry about inflation, then the logical step to take is keep interest rates elevated, keep quantitative tightening a thing that will stay longer, and maybe, if necessary, increase interest rates. Increasing interest rates at current economic conditions with a weakening labor market is quite not the thing you want to be doing, all right? But again, there's no other choice. A recession is better than an inflationary spiral. So that's the macro view, all right? That's the macro view on the situation of why the collapsing ceasefire is not a good thing for markets. Bitcoin already started to feel the effects of that ceasefire, or the probability that central banks will be more hawkish because of increasing oil prices. And that's why what seems like right now is we're getting a fake out when we try to reclaim the rising wedge pattern. Now, the rising wedge pattern is pretty bearish pattern, especially in bear markets. 60-70% of the time it breaks down. But when it breaks down, this is very important. Sometimes we shift into new patterns. Sometimes we actually have trend continuation and we go down to new levels. All right, we need to understand that breakdown doesn't mean just market crash. No. We could break down, shift into another market structure, and then break up, right? And those are the things I usually look for. A breakdown does not confirm. That's why we anticipated that this might be a fake breakdown, because you not only retest of the support, but you also need higher volume on the breakdown as well, or a continuation candle. Only one happened, which was the retest of the support. This way we were able to reclaim up, right? So it was a fake out. Right now, it seems like we may be again breaking down of the pattern. And if we do, I think a reclaim of that pattern will be probabilistically less likely, right? Much less likely. If you see here, I mean, if you want to look at recency bias and the previous rising wedge pattern, which we have discussed and actually predicted pretty well, and we were able to carry out the whole move, right, from there to here to here in previous videos. I think we might see something similar again sometime. Don't know when. but sometime. What we're seeing right now is compression in volume, which is usually a signal before a breakout in either direction. And that reduce in volume is on a trend upswing, which usually means bearish divergence type of thing, right? So the important things to, the three scenarios that we can have, right? Scenario one. America exits, ceasefire remains, and oil prices go back to their levels, and risk assets such as Bitcoin stock markets will rally. Scenario two. Ceasefire remains, but there's minor violations in between, and this will put pressure on markets, neutral to bearish. Scenario three. Ceasefire collapses, ground troops and invasion by the US, and conflicts in the Middle East intensifies, markets collapse. It's three simple things. Of course, there could be other scenarios, and nothing said in this video is financial advice. It's only for educational purposes only. I hope you enjoyed the video, and if you did, please do like and subscribe. It really helps the channel, and I'll see you in the next one.